Hi everyone, welcome to ACCA Financial Accounting, previously known as F3. I'm Matthew Kameringa. I'm going to take you through this paper. Together we are going to push beyond boundaries. So we want to do our revision on consolidation. This chapter is very demanding. You cannot go to the exam without knowing consolidation. So we do have the statement of profit or loss. We do have the statement of financial position. You must be able to prepare those statements when you are given a question in the exam. So, but before we look into our question, before we do statement of financial position in the profit or loss, I want us to refresh our memories on markup and margin concept. I'm pretty sure that you learned that from your primary school learning. So let's refresh our memory. Right, what is markup? What is margin? What is markup? What is margin? What I know is markup is profits, margin is profits. So what's the difference? So for you to get the markup, you have to multiply by the cost of sales. What about if you are given a margin, you have to multiply with the revenue, we call it the sales. Right. So you must be able to calculate the profit in the exam when you're given the markup or when you're given the margin. But the challenge comes when, for example, you are given the revenue. The question is saying, for example, this company sold these goods at a markup, for example. So you might be given the markup, for example, let's say a markup of 25%, but you're given the revenue of, for argument's sake, let's say 10,000. Can you see that this is not like with like? So because for you to get the profit, if you are given the revenue, you have to multiply by the margin. If you are given the cost of sales, you have to multiply by the markup. So, for example, if my margin is 20%, I'll just say 20 over 100 multiplied by 20,000, then I'll get my profit. But if you are given the markup, you cannot use markup to get the profit when you are given the sales. So that means you have to convert this markup to margin. So how do you convert the markup to margin? Here is the formula from the primary school learning, A over B. So when you want to convert the markup to margin, A over B, how do you convert A over B plus A? So this is 25%, right? This is the percentage. When I want to convert this markup to margin, I'll say 25 over 100. A will be the denominator. I have to add the 25, which will be 25 over 125. Then my profit, I'll then multiply by 10,000. Then you get your profit. That's how you convert. So when you are converting the margin to markup, that's vice versa. You deduct the denominator now. So for example, let's say there is a margin of 20%. If you want to convert it to markup, this will be 20 over, the formula is A over B minus A. So 20% margin, I want to convert it to markup. So this will be 20 over 100 minus 20. So this will be 20 over 80. So that's how you convert. Or you can use this markup to margin. Markup to margin. Markup to margin. This is how I write the markup. If you want to convert the markup to margin, how do you do it? So this is what I do. Markup to, are you seeing that? When you write markup, this is the negative sign. To margin, this is a positive sign. So if you want to convert the markup to margin, Markup to margin, you add the denominator. Margin to markup, you deduct the denominator. Alright? So, we are going to apply this concept when you look at a question. Alright? Right. So we want to do consolidation. Consolidation, what is consolidation? Consolidation means adding together. You might have company A and company B. So let's say, for example, company A might purchase company B if they buy the shares that exceeds 50%. We say now that company is now called a parent. A parent is an entity that controls one or more entities. But the company that is acquired, which is the acquiring, that company, we call it the subsidiary. So we have the financial statements of the parent and the financial statements of the subsidiary. Now, when you want to consolidate, it means you want to combine. It means you have to add the financial statements. You might add the assets, liabilities, equity, revenues, and the expenses. We are now presenting the financial statements of different entities as a single economic entities. Because when one entity controls another entity, that company that controls another entity, it's called a parent, and that is controlled, it's called a subsidiary. So when we want to consolidate, we have to present it as a single company. That's consolidation. Consolidation means adding together. And it also means the cancellation of like items that are internal to the group. So we are going to eliminate any internal transaction, any intra-group transaction, because when you prepare the financial statements, we do not want to include the internal transaction or any transaction between the parent and the subsidiary. So we want us to look at a question. So I do use both BBP and the Kaplan. So today allow me to use the BBP revision kit. Let's look at this question, swing and cat. So what are we required to do? We want us to prepare the consolidated statement of financial position and the consolidated statement of profit or loss. So let me read the question. Swing purchased 80% of C equity on 1 January 2007 for 120,000 when the retained earnings were 50,000. The fair value of non-controlling interest on that date was 40,000. During the year, they are telling us that Swing sold goods which cost at an invoice of 100,000, and there is a 50% of the goods that are still in inventory. So the year end is 31st of December 2008, and given the profit or loss and the financial position. So deep breath, everyone. So let us look at the question now. So when you are doing the statement of financial position, you have to remember working 1 to working 5. W1, you have to prepare the group structure. W2, the net assets of subsidiary. W3, the goodwill. W4, the NCI, non-controlling interest. W5, group retained earnings. Right. So you must know working 1, working 2 to working 5. So let's start with working 1. Group structure. We have seen that Swing purchased 80% to get, what was the acquisition date? They are telling us that Swing purchased 80% on 1 January 2007. So this is the acquisition date. This is the date that Swing gained control over C. Right. And also, they are telling us that they sold goods to each other. So before I do working 2, I need to know the profit that was made by the one who sold the goods. So they are telling us Swing sold goods which cost 8 at an invoice of 100,000. So now they sold goods to each other. So allow me to calculate the PAP. What is PAP? PAP, this is the provision for unrealized profit. Remember, I said that when you sell the goods, either the parent sell goods to the subsidiary or even the subsidiary to the parent, that's an intercompany, that's an internal transaction, or it's called the intragroup. So any intragroup transaction must not be included in the consolidated statement of financial position or even in the profit or loss. We must eliminate any internal transaction. So I need to know the profit that was made by the one who sold the goods. So they are telling us that Swing sold goods at an invoice of 100,000. They have a cost of what? They have a cost of 80,000. This shows that the one who sold the goods made a profit of 20,000. So 20,000 is the profit. But we need to know now the profit that is in inventory, the profit that is in the books. So they are telling us that Katie had 50% of the goods still in inventory. So you need to read the question very well in the exam. You need to know the percentage of the fraction that is still in inventory. So when you know the profit element that is in inventory, then you eliminate it now. So sometimes they can even say 40% of the goods were sold. So what is the percentage that is in inventory? The remainder, which is 60%. So make sure you read the question carefully now. So 20,000 multiplied by the percentage that is in inventory, they are telling us that 50% is still in inventory. So this is the profit that is in the books that we must eliminate now. So the 50% of 20,000, that's 10,000. Common sense. Right. Then we move on. Now we want to eliminate, we must eliminate this PAP. So are you going to deduct it from the working 2 or from the working 5? So working 2, this is the net assets of subsidiary. Who is our subsidiary? Our subsidiary is Keta. W5 group retained earnings. This is the retained earnings. That's for parent, that's Swing. So who sold the goods? They are telling us that Swing sold the goods, meaning that Swing is the one who made the profit. So we are going to eliminate that profit in W5. If the subsidiary was the seller, we were going to eliminate the PAP in working 2. So we move on now to W2. W2, the net assets of subsidiary. Net assets of subsidiary, we have the acquisition debt, we have the reporting debt. Right. We acquired on 1 January 2007, then the reporting date, that's the 31st of December 2008. So what are we doing? Why are we preparing working 2? The reason why we are preparing working 2, we need to value the company of a subsidiary. Working 2, this is net assets of subsidiary. Right. So we want to value the company. This is what? This is our equity. This is our equity. So if you look at the financial position, what do we have? We have the share capital and the retained earnings. We have the share capital and the retained earnings. And the information that is presented, you'll be given the information that is presented at the reporting date, meaning that at the year end, right? So what do we have? The first column is for the parent and the last column is for the subsidiary. So that shows that I'm supposed to take 120, that's my share capital, then 200, that's my retained earnings. What you must know is the share capital doesn't change. The capital does not change, so that means still on the acquisition date will still be 100. What about the retained earnings? The retained earnings, these are your profits. So profits, they do change. Sometimes you might make a profit, sometimes you might make a loss. So you need to now look at a question if you are given the retained earnings at the date of acquisition. So we are given the retained earnings at acquisition. They told us that the date that we acquired the company, the date that we purchased them, there were the retained earnings of 50,000, which is 50. So I'm supposed to put 3 zeros on the top. Right. Do we have any additional information? We don't have any additional information. If there are any assets that have increased in value, you are supposed to add any fair value adjustment of assets. If there is any asset that increases in value, you add. Because what we are doing, we are giving a value to the company that was acquired. We need to know, yes, you acquired Keta, but what was the value of the company when you acquired that company? That's what you want to know. And of course, we are not going to deduct PAP here because it is not the subsidiary who sold the goods. So let me close off. We do the number crunching. This will be 150. This will be 300. So this shows that at the date of acquisition, the subsidiary had a value of 150. Then at the reporting data, from the date that you acquired, the company now had a value of 300. So that means the company, they gained 150. So we call it the post-acquisition profit. So this is the profit that was made by the group. And what about the share that we are going to give the parent? If you acquire 80%, we give you 80%. So subsidiary, the parent acquired 80% to the subsidiary, so that means 80% will go to the parent, and the remainder will go to non-controlling interest, right? Then W3, goodwill. Many people do not understand the goodwill. What is goodwill? Yes, when you are doing consolidation, goodwill will see it as an intangible asset. Because you are acquiring a company that is already operating. So there is a benefit that you get, which is the reputation. Allow me to hammer this question. Easy stuff. Right. So I'll start with the purchase consideration. Purchase consideration, this is the amount that you paid, right? How much did you pay to acquire the company? We paid 120. Then you add the fair value of NCI at the date of acquisition. What was the fair value of NCI? That's 40,000. Then you compare with the value of the company at the acquisition date. When you acquired the company had a value of what? Of 150,000. Okay? So less the net assets of subsidiary at acquisition date. Then you do the number crunching exercise on your adding machine. I'm pretty sure that you get something like that. 10, which is your goodwill at acquisition. When you are doing the advanced module, probably you'll be given an impairment. They will tell you that your goodwill at the reporting date needs to be impaired. So if there is any impairment loss, you reduce your goodwill with the impairment, then you get the goodwill at the date of the reporting. Right, then the last thing, move on to working 4 and working 5. Working 4 and working 5 now, I want to kill 2 birds with 1 stone. Right, let me just write this down. Profit, that's 150. What about our goodwill? Our goodwill, that's 10. Right. So let me prepare working 4 and working 5. Working 4 and working 5. Those are the last workings. Group retained earnings. Right. The NCI at acquisition, then the parent's earnings. At acquisition, what is the value of NCI? That's 40. And this is the same amount that we wrote when you prepared goodwill working 3. The balance, the parent's earnings. Parent had the retained earnings of 400. Right. So these are the balances that are given. So no need to worry. Then now, We have discovered that the group made a profit of 150,000. So we must share this profit to working 4 and to working 5. Parent is the one who invested. So we are interested in knowing the retained earnings in the profits that we have now. So W5 is for swing, is for the parent. So we record the post-acquisition profits. Parent is getting 80% because he invested 80%. So it's getting 80% of 150. Then the remainder will be recorded to W4, which is 20% of 150. Right. What do you get? 20% of 150, you get 30. You sum up this, 70, you close off. Then the remainder, or just say 8% of 150, which is 120. Right. But I'm not going to close off, I'm not going to forget the PAP, the provision for unrealized profit. Our PAP, we calculated our PAP, the provision for unrealized profits, and when you calculated the PAP, that was 10,000, right? So I'm going to less PAP here. Why are we deducting the provision for unrealized in working 5? It is because the parent was the seller, right? Or we can just calculate it here. We've calculated it before, and we say 100 less 80. That was the profit, and the percentage that was in stock, that was 50. Right. So you less your PAP 10, then you close off. You sum up, and you get 510. The last thing, we are now presenting the statement of financial position. We now have the LCI balance working 4, we have working 5 group retained earnings, we have the goodwill of 10, right? So it's now easy to prepare the financial position. Now, statement of financial position. From the primary school learning, you say that assets is equals to capital plus liability. So now we call it the equity plus liability. So we are saying that the left hand side is to equal the right hand side. Okay? So the consolidated statement of financial position. The consolidated statement of financial position. Consolidated statement of financial position is at 31st of December 2008. You start with the non-current assets heading. The first thing that I do recommend is start with your goodwill before you forget. Our goodwill was 10. I said that consolidation means adding together. You are adding the financial statements of the parent and the financial statements of the subsidiary, right? So you just copy and paste right. We have the tangible non-current assets. Tangible non-current assets, that's your PPE, right? That's your PPE. So the parent is 18.8 plus the subsidiary 200. Then there is no any fair value gain. So we close off. Then what do we have? Under current assets, we have our inventory. Consolidation means adding together. Add subsidiary and the parent, trade receivables. Trade receivables, that's 650 and 40. We have the bank balance, bank and cash. You add, that's 390 and 35. Right. Before you close off, on inventory, remember there was the profit that was made by the one who sold the goods. So we must remove the PAP. and we've calculated the PAP, and our PAP was 10. So you less the PAP less 10. On trade receivables, if they owe each other, you must eliminate again. Remember, want to eliminate any intra-group transaction. So currently, on this question we don't have. So you close off, then you sum up. Right. We have 610 here. We have 619 using accelerators. And we have 425. Most people, they spend a lot of time doing consolidation. The reason why I'm taking time is because I am explaining right. So when you are in the exam, make sure that you keep your eye on the clock, right? So it is about time management. So what do we have? The total assets here. Total assets. If you do the number crunching, you get this. Then I said the left hand side has to equal the right hand side, right? Then we have the equity and liabilities. Sorry, I forgot to add the PPE. 18.8 plus 200. This is 28. So plus 17.5. So that's 38.15. Right. Equity and liabilities now. We start with the equity. The equity, you just copy and paste. What do we have? We have the share capital and the retained earnings. Your capital, you record. Now, yes, we said that consolidation means adding together. You are adding the financial statements of a parent and a subsidiary, right? But on the share capital, you only take the amount of the parent. You don't take that of the subsidiary. Why? Because we have already recorded in working 2. We have already recorded the amounts of subsidiary in working 2. So I'm only taking for parent, which is 2,000. Then the retained earnings, we have calculated before the retained earnings. What I know in my financial position, I must have W3, I must have W5. Not forgetting, you can't just have 3 and 5. You also need the W4, which is what? Which is your NCI. That's why I said you kill 2 birds with 1 stone. Retained earnings and the NCI. So the NCI, that's 70. And 70 here. The retained earnings, that's 510. Then that's the equity. Then what about the current liabilities? Current liabilities. Consolidation means adding together. Trade payables and the tax. 910 plus 8. What about the tax? The tax, that's 2/3. That's 2/3 plus 65, right? So you add 940, 2/3 plus 65, 295. Do we have the non-current liabilities? I don't think so. We don't have the non-current liabilities. So if I sum up these amounts, this shows that the left hand side is equal to the right hand side. And I'm pretty sure that I've hammered this question.